September's here and you're wondering, which stock should I buy now? Keep in mind that historically September's a weaker month and we could see some more volatility. So I'm going to look at stocks that I think are attractive. I'm also going to look at valuation and I'm going to look at a chart for each stock. Now, when we look at the technical analysis, remember that fundamentals are always first. We're using those charts to get a better idea of where the stock could go on the upside and the downside, really to help us get better entry and exit points when we're dollar cost averaging for long-term investing. I'm excited about this one, guys. Let's get started. The first stock is Paycom. I have been buying this stock, and since we haven't covered this stock on the channel before, I'm going to go a little bit deeper on this one. So what is Paycom? What does Paycom software even do? From a high level, it's HCM software, so human capital management, so human resources. And when you look at the inception of the company back in 1998, payroll has really been a focus of this company. Now, it has branched out and has more modules. I'm going to do a comparison in a second here against Workday just to show you the differences here. So Paycom allows employees to access pay stubs and tax forms, self-onboard, train and develop, update personal information, submit PTO requests and expenses, enroll in benefits, and more.
Psst. Susan! What? Why are you whispering? Check this out. With Paycom, employees do their own payroll.
What's Paycom? A magic payroll genie? Like, ooh, what's your wish?
It's an app that employees use to do their payroll.
Oh, whoa. Payroll is way too complicated for the average person.
Yes.
Not really. Paycom guides them through it.
Yeah, right. They'll screw it up.
I don't know how. It automatically detects errors, like missing or duplicate punches, pending expenses, unapproved PTO, tax setup problems, on and on.
Okay, but then what happens? They come running to us and we have to fix it for them.
Looks like employees fix errors themselves before payrolls run.
In the app?
In the app.
Now let's just focus on smaller businesses and I'll cover that in a second. So why did Paycom stocks sell off recently? So the recent quarter wasn't bad. It saw a 26.6% jump in total revenue. It also saw recurring revenue climb 26.6%, the same number. And it was a slight miss, $395.5 million versus analyst expectations of $398.4 million. The adjusted EPS, earnings per share, it rose by 28.6% and that topped consensus by 2 cents. Adjusted EBITDA was also strong. That rose by 30.9%. And Paycom generated $105.9 million in operating cash flow. Adjusted gross margin, 84%. That is down slightly from 84.6% a year ago. So the earnings were pretty solid overall, but the reality is that we saw one of its smallest beats in a while in recent memory. And the market was also not impressed with guidance. Now, with that said, listening to the earnings call, it was very upbeat and overall positive. So Paycom is focused more on SMB, so small and mid-sized companies. Now, when you look at best in breed for HCM suites, software suites, Workday is really going to be the leader. And you can see here 2022 Gartner Magic Quadrant. They're the leader for cloud HCM suites. Now the key here is for 1,000 plus employee enterprises. So Workday is focused more on those larger businesses. Just like when we talk about CrowdStrike's focused mostly on the larger enterprises, where SentinelOne's focused more on the SMB. So when you look at that Magic Quadrant, again, this is for 1,000 employees and more. You've got Workday and Oracle really up there in the top for the leaders. So what are the main differences between Paycom and Workday? There are a lot of similarities, but the two key differences: Paycom does not have financial management and also does not have very good ERP integration. So what does that mean in simple forms? It's just harder for larger enterprises to use something like Paycom because it doesn't plug into their existing IT infrastructure as easily. Now, when you look specifically at payroll, which has really been the focus of the company, like we mentioned earlier, this is 2019 and Paycom HCM was really up there as the leader. But in less than 2 years, from December 2019 to January of 2022, you can see that fell below Bamboo HR. You can also see that QuickBooks is right below it and Workday is climbing up. So when you think of those smaller businesses, economic impacts do matter. When the economy is tougher, it's going to be harder for those smaller businesses. They're going to have to cut costs, they're going to have to cut employees, and it will impact smaller companies or companies that are focused on smaller businesses like Paycom. So I think that's part of the sell-off. There's also more competition, as I just showed you on that previous slide. And the growth is slowing, although it's still solid, especially when you look at the valuation metrics. And we'll look more at those metrics here in a second. So Paycom, you can see the 52-week range here. The low, $262.12. The high, $375.84. According to Fidelity here, the PE ratio, 54.17, and this is going to be a $17.89 billion market cap. It does also pay a dividend about 0.5%. Now you look at this chart here, you can see I'm back here on November 27th of 2019. It was trading basically at the same price it's trading at today. Short interest is 2%. Price to sales ratio is 10.99. But remember, this is a software as a service company that has recurring revenue, so we're going to look at some other metrics as well. And with that said, the PE for this year's estimate is 38.4, and next year's estimate is a 32. So the EV NTM revenue is 8.5x. It's got positive free cash flow, and that rule of 40 is over 40%. So I wanted to compare the valuation with some other HCM and payroll companies. So you have Workday in the green, SAP in the blue, ADP is in the orange, and then in the purple, of course, you got Paycom. And you can see Paycom 38.54. This is a forward PE ratio. Workday is more expensive at 44.64. Now, where it gets interesting is when you look at the growth. This is going to show you quarterly year-over-year growth for revenue. Paycom actually has the most at 26.57%. And we just looked and showed you that Workday has a higher valuation, yet the growth is down here at 16.34%. SAP is down here at 7.33%, and ADP is only at 6.03%. So let's look at profit margin. Paycom, again, the leader, 20.28%. And Workday is actually down here at negative 1.81%. So if you ask me, what company is best in breed for HCM when you think of SaaS? The answer is probably going to be Workday, but I can make an argument that Paycom is a better buy here. Now, you don't buy stocks simply off these analyst recommendations and price targets. But with that said, the low is $325. That's 10% higher than we're at now. And the high here is at $450. That's 52% higher than it's trading at. So you have 16 buy ratings, 2 outperform, 4 hold, 0 underperform, and then 1 sell. So here are some reasons why I think Paycom stock is a buy now. So Paycom recently launched in Canada, increasing international expansion efforts. And Paycom is trying to expand into other areas as well over the next several years. As Paycom expands internationally, it'll be able to pursue those larger companies with 10,000 employees and more. So Paycom's going to continue to try to move up market. Now, it's harder for Paycom to compete with the big dogs like Workday, SAP, and Oracle. There's no question. And I used to work for Oracle, so I have a pretty good idea. Paycom launched 2 new tools in the quarter, Everyday and Client Action Center. So Everyday gives employees the option to be paid early without fees. It's really designed for lower wage employees in certain industries, specific industries. And then the Client Action Center is an intuitive dashboard within the Paycom mobile app. Now, if you do your homework on Paycom, you're going to find out there some customer reviews. And one of the negatives you hear is that the software is not very intuitive. Essentially, they've made a solid product, but they haven't done a great job of continuing to innovate and improve. And some of those newer competitors are starting to come in with more advanced, more updated dashboards and whatnot. So it is good to see that Paycom is starting to address that, because if they don't, that could be a big thing. So Paycom's Net Promoter Score, NPS, is 56. Now that's the highest among its peer group in the HCM industry. It also has one of the highest net income margins of the group. Founder and CEO Chad Richardson said he believes that Paycom only has a 5% share of the TAM, total addressable market. And of course, that leaves a tremendous runway for future growth. So Paycom entered the quarter with $537 million of cash and only $29 million of debt. And it is a profitable software company with recurring revenue. Now, this is important too. So Paycom held an average daily balance of $2.2 billion for its clients, and it earns interest off of this money. In fact, it earns approximately $5 million annually for every 25 basis point increase when you think of the interest rates. Now, that's both a pro and a con. Why? Because as interest rates have gone higher, Paycom has benefited. When interest rates start going the other way, the reverse effect, of course, is going to happen. Now, with that said, as interest rates come down, that should also improve the sentiment of SMB. Now, this is a really unique company because it's a DGIF, so it pays a dividend. It's a small yield, 0.51%, but it could be a great compounder for you if you hold it for 5 or 10 years. And we looked earlier at valuation, still decent growth plus that recurring revenue we talked about. So Paycom has an excellent combination of growth, strong profitability, and a solid net promoter score, and it creates, in my opinion, an interesting buying opportunity. So let's look at a chart and see where the stock might be headed next. So in each stock today, I'm going to show you a chart. We're going to look at technical analysis. I'm going to show you some possibilities where the stocks could go. When you see orange, that's a previous chart day. Yellow is going to be today's information. Keep in mind, fundamentals are always first, and technical analysis is not some crystal ball. It's giving you possibilities of what could happen. If the whole market breaks down and sells off, all bets are off, and technicals can break down really quickly. So we're just looking at possibilities here for opportunities to dollar cost average as long-term investors. So if the market doesn't roll over, this looks like it probably bottomed here. Most of the Discord buys have been focused on $290 and less dollar cost average. The brief low was $276.64. So if the market remains bullish, you're going to have to recapture these moving averages here. And I think the stock could pop up to $325 to $330. So we just got some huge news here over the last couple of days. Billionaire Forrest Lee C relaunches popular mobile game Free Fire in India after the ban. It feels like since this ban in India, the stock has just been in a free fall. Of course, C Limited has been impacted mostly from its gaming segment, but the game is coming back to India and it's going to be available for download September 5th. It's now called Free Fire India. So I think this is a big move and it could be a catalyst. So this is one of those stocks. There might be people watching that absolutely hate this because they might have bought it in 2021, might be underwater or lost money and already sold it. Past performance does not guarantee future results, and that goes for both directions, up or down. So is this an opportunity here? Let's take a look. Now, if you would have bought this stock at the top in 2021, closer to like $375, well, you're down 90%. If you bought the stock 5 years ago, you're up over 185%. So of course, what you buy matters, and when you buy does matter. So right now, the market cap is $21.83 billion. Now, of course, that used to be much higher at one point, and it was way overvalued at one point. The question that we need to ask is it overpriced now? Is it an opportunity to buy? Well, looking at price to sales ratio, 1.68. The PE for this year's estimate, 29 according to Fidelity, and 30.7 for next year's estimate. Now, this chart is showing you price to sales ratio in the purple and the forward PE ratio in the orange. So this company going into profitability, 17.42 forward PE ratio. And if you just look at price to sales at 1.755, this is the lowest it's ever been since the company went public. And you can see this chart's going all the way back here to 2018. So growth has slowed down, competition has increased, sentiment has fallen off a cliff. Could the stock go lower? Absolutely. When's usually the best time to buy stocks? When nobody else wants to buy them. Again, you don't use analyst price targets to buy stocks, but I think it's interesting to look at. So C Limited has a low here of $29. That's 25% lower. The high, $145, that's up 276% from where it's trading at right now. Now, I'm not saying it's going to go to $145 overnight, but even if it went to the median of $64.50, that's a 67% increase. So what's the chart say? Well, it's trying to bottom, and actually this is looking like a pretty decent chance here, this little bounce. Now, if you see this yellow circle, I shared this in Discord after it had the earnings miss. And at that point, the stock was around $44, and I circled this and said that the stock could go lower. So this circle is really between $30 and $36. And the stock got down to $34.27. You can see here I said gap down, would not be shocked to see under $30, but likely gets buyers between 30 and 35 bucks, and that's exactly what happened. Now, if it continues to recover, and keep in mind, this could break down and go lower anytime. This S2 is around $27, and the S3 is at $15. So those are possibilities. I don't think it's going to happen, but I think it is possible. It looks like it wants to bottom here, and if it goes up to this P, you're looking at about $46 in this red line. I think it could rebound to $46 to $50 from here. Now, of course, this stock is in the doghouse, and it's going to have to prove itself. If it has another earnings miss, well, it's going to go back down, and you could see even new lows. So there's definitely risk if you're buying this stock. I'm not saying that it's risk-free. I try to look at risk-reward and what opportunities might be out there for us to buy. And this definitely has potential to give you tremendous returns. It also has risk to the downside. But of course, looking at this stock over the last couple of years, I'd much rather buy it here than buy it back in 2021. The next stock is Enphase Energy, and you can see the 52-week range, $120.90 to $339.92.
It's not hard, no. It's, I mean, you have to be smart. You have to be really smart. You have to use your brain. You know, I have to use my brain. I like to see when the stocks are high, okay, and I like to see when they're low. That's the big thing.
interesting.
And sometimes they're really high. Sometimes they're very high, the stocks. And you go very high. That's when you
high.
want. Yeah. That's when you want to sell, when they're very high.
Woo.
You buy them when they're down very low.
Now, interest rates do impact this stock, and you could see more pressure on it. This is another one of those stocks that was very popular, and basically sentiment fell off a cliff. You know, just back in December of 2022, this was a $340 stock. Now it's trading at $128.73. So is this an opportunity? $17.55 billion market cap. It does have 7.59% short interest, so keep that in mind. Price to sales ratio, 6.28. PEG ratio of 1.27. Now, generally speaking, when people like to use PEG ratios, they try to find PEG ratios of 1 or less. For the growth that this company has, 1.27 is not a bad number. The PE for this year's estimate, 25.3. Next year's estimate, 19.5. So you can see Enphase is down 51.47% year to date. This is another one, the lowest on here. Again, you don't buy stocks off of these analyst price targets, but the lowest target is 135, which is 5% higher than now. And the high is $262. That's 103.7% higher than it's trading at now. So the median price of $200 is a 55% increase. We're going to look at a chart next, but I want to break this down. Now, if you're interested in more due diligence, deeper dive on Enphase, I've got a couple of videos on the channel. You can go watch those after this one's done. So the stocks that I've covered on the channel before, I'm not going to go as deep on today. But I want to reiterate that interest rates have impacted this company, this stock, and that could continue. And you might see another miss next earnings, and you could see new lows in the stock. Another thing I want to address is when you think of microinverters. A lot of investors that are bearish on Enphase, one of the arguments you see a lot is about this. When you think of microinverters, do they really have a moat? Because really a lot of different vendors can create these, can produce these. So Enphase is really considered kind of the best in breed for microinverters. But in reality, just so you understand, it's not rocket science. It's not advanced technology. We're not talking about GPUs from NVIDIA. We're not talking about H100 AI chips or anything like that. And Enphase is getting more into when you think of the battery storage, when you think of EV charging and so on, really trying to have that home network, the software, the apps, all of it. But generally speaking, the solar panel is going to be produced by someone else, and it's going to use one of those microinverters from Enphase. So there's no question that solar panels are a commodity. With microinverters, Enphase has a good reputation. They're really kind of the leader, but there are many other companies that make them and that could make them. So it's something to keep in mind if you're investing in this company.
Yeah. I mean, I have graphs. I have some graphs I can show you. If you pay attention to these patterns here, you can see on the graphs. I made these on my computer.
Wow.
Okay, so I circled this down here, and I told Discord, I don't want to buy it until it gets to $125 or less. And I remember the stock, you would sit there at 150, 140, 130, and people were like, what's another couple of dollars? And I'm like, 125, or I'm not going to buy it in my main. And it got down below $125, just around 121 bucks. I did buy some in my main portfolio. So we do own Enphase in the main, as well as the Fired Up Wealth community portfolio. So we talked about these points already. Interest rate sensitive. You could see another drop next earnings. And there's a lot more DD on this company on our channel. So go check out some other videos when this one's over. You can just do a search, Enphase Fired Up Wealth, and you can find them. But I believe $125 or less DCA as a 5-year investment, it looks strong to me. There are certainly risks to it, but it looks like a decent risk reward at these price levels. Even where it's at right now, it's 128.73. I prefer 125 or less, but if you're nibbling it at 130 and you buy more, just don't be surprised if the stock takes another leg lower. And if it does, that's where I'd load up. If it gets below $100 a share, that's where I'd probably pound the table. And I'm not saying that it's going to happen. I'm saying it's a possibility, which is why we use dollar cost averaging in the first place, because timing the bottom is basically impossible. So we have educated guesses of where the stock could go, and we're buying in those ranges. And so look at some of these comments from previous chart days. We'll need to consolidate. Be careful. This is when it was over $300 a share. If it's me, I'm waiting for below $200. Then it got below $200. I assessed. I liked it at 150, but I thought I could go lower, and I decided 125 or less. So if you bought the stock higher, if you bought it at $150, $160, I think if you're holding it 5 years, if that story comes to fruition, you're still going to be happy with that investment. And if you didn't add a full position, it could be an opportunity to nibble some more shares lower. Full disclosure on the next stock pick, people in Discord know exactly what I'm talking about. Kryptonite. So you have to be careful with Kryptonite, but armed with new executives, DLocal rebounds from short seller attack in a big way. This stock was filled with all sorts of drama in 2022. So this is a South American fintech company. Recently, we saw the stock pop 30% in a single day. And that was because of the news that the payments outfit had tapped former Mercado Libre CFO as its new co-CEO. So you got two CEOs here. And he also had an earnings beat here recently on August 15th. DLocal reported revenue of 161 million, up 59% year over year and 17% quarter over quarter. Also a jump in profits, gross profit, and more. So if you're not familiar, founded in 2016, DLocal connects global enterprise merchants with billions of emerging market consumers in over 40 countries. So you're talking about Asia Pacific, Middle East, a lot of developing nations, Latin America, Africa, and so on. Some of DLocal's customers have included Amazon, Booking.com, Dropbox, GoDaddy, MailChimp, Microsoft, Spotify, TripAdvisor, Uber, and more. We don't have time to go too deep, but just from a high level here, DLocal is offering one API and 900 plus payment methods. Some really impressive numbers here, and we've seen short reports on this stock. It's a tough one, it really is, because this could be a massive performer in your portfolio, but it does carry some unique risks. 107% compound annual growth rate. That's crazy. I mean, revenue 96% on the compound annual growth rate. Gross profit, 78%. The thing that's tough for me, just about fintech in general, it's definitely a secular growth trend. There's a lot of these companies that are growing, that are doing good things, but there's gonna have to be some consolidation at some point. And you look at something like DLocal and say, how hard is it to disrupt this? I mean, does it really have a true moat? I think it's pretty easy to argue that it really doesn't. They're doing good things and the numbers look strong, and I do like the stock. I don't own it right now. And the reason I tell you this stuff is I like to just keep it real. I mean, there are risks with every investment you make. And it's important to understand both the bull side and the bear side. And you have to be careful with some of these slide decks. Huge market opportunity, $1.4 trillion digital payments. I mean, yeah, of course, it's a huge total addressable market. There's lots of market opportunity. What I really care is what's the SAM? What's the serviceable addressable market? How much are you going to actually capture? But there's no question, guys, there's huge opportunity with this. So on the bull side, DLocal does stand out as an emerging markets disruptor when you think of payments. This most recent earnings report was pretty solid. New executive management, you can't argue with the track record. Valued at 19x next year's EBITDA. So it's got profitability, it's got growth potential, unique market position, and that makes it an attractive investment opportunity, and that's why I'm bringing it to you on this video. So here's some of the numbers. Q2, and this is GAAP EPS, not non-GAAP, but GAAP EPS, 15 cents, beat by 2 cents. Revenue of 161.14 million, that's up almost 60% year over year, and it beat by almost 12 million. So US $4.4 billion of total payment volume. That's up 80% year over year. That's pretty big. 148% net revenue retention rate. And you look at this and say, well, what am I missing? I mean, there's short interest of 11.85%. So there are definitely people that don't believe in this company. So 52-week range, $9.03 was the low. The high, $27.59. Trading right now at $21.61. Has a $6.35 billion market cap. And you can see this nice gap up here on the chart. This was a 30% move to the top here. And it's probably going to fight, if you see the top of that candle, it's probably going to fight back to that $24, $25 range. With that short interest though, keep in mind, 11%. Price to sales ratio, 12.05. Sounds expensive, but then you can also look at the PE ratio, 38.2 for this year's estimate, 28.3 for next year's estimate. PEG ratio on this one's 1.74. Okay, what else can we look at? So looking at the chart here, in the purple, that's the forward PE ratio. The orange is going to be price to sales. And this is going back to since when the stock first started trading public. Of course, like many things, it was way overvalued up here. It didn't have any PE ratio and it was price to sales of 120 plus. Well, now that price of sales went from 120 plus to 12.73, which isn't cheap. But you look at the forward PE ratio, 38.19, and you look at the growth and the total addressable market and the opportunity, it starts getting much more attractive. Now, this would have been much better to buy before the pop. But with that said, that pop came from a catalyst, and that catalyst is why I'm interested in the stock, because it's really changed the sentiment for me and a lot of other investors. So this is a wild chart. You've got this gap down, you've got this gap up. This is crazy, double bottom, huge pop up here. Topped out at $24, then pulled back. So it did this huge pop up, pull back. This stock's going to continue to be volatile, and you have to be careful. I'm not saying go load up the boat here, but it had a double bottom, it had solid earnings, and it had catalysts when you think of new leadership. So previously I said back to $24, it did exactly that, and then pulled back from there. So you do have to be careful, because I'll admit, you are chasing above the trend line and the moving averages. And if there weren't an actual fundamental catalyst, I would look at the chart and say, be really careful, don't touch it. Because there's an actual catalyst, I think it can support support the stock going higher. But remember, kryptonite, be careful because this easily could pull back into this gap. You might see it come down. My preference on the stock is $20 or less DCA long-term, and I consider it spec, although a lot of you probably consider it growth. I've got more stock picks, so hold on. But before I go on, if you're new here, do me a favor, subscribe to the channel, click that bell for notifications. We're just at 50,000 subscribers. Let's take it to 100,000. And if this video is helpful, drop me a like and drop me a comment. And I need to announce this video is sponsored by the Motley Fool. If you'd like to see the 10 best stocks to buy now, visit fool.com/firedupwealth. A reminder, I'm independent from Fool. They don't tell me what to say, what to make. They're a great partner. Check those guys out. You can also join us in our private community, Patreon Discord. We're having a lot of fun in there. We're crushing it. We just added some great new features. Check it out. Visit patreon.com/firedupwealth. I want to show you Unity software, and you might be surprised at what you see. So definitely watch this. So 52-week range, $21.22. That would have been a nice buy. 52-week high, $50.08. Another one of these nasty charts. This was a $200 stock back in November of 2021. Now trading at $37 a share. And that's off a low of $21 a share. Market cap, $14.2 billion. Short interest, 7.4%. Something to keep in mind. Are you guys familiar with Unity's new AI tools? Check this out.
Hello there.
Greetings.
What's your name?
My name is Orb. I'm an extraterrestrial visitor who has come to Earth to study and understand humans.
What hairstyles would you choose if you had hair?
If I had hair, I would probably go for a messy bun or ponytail. I like how they look on other people and I think they're easy to maintain.
What's the secret to life?
The secret to life is to find something you love to do and do it every day.
I'll be honest with you, stocks like this, they're hard to put a value on. They're hard to understand for a lot of investors. This is a complex company. There's a lot going on, and I'm actually really bullish about Unity longer term. And this is a 7.37 price to sales. PE for this year's estimate, 60.2. Next year, 33.3. This company is starting to turn a corner. Anything that was an IPO in especially 2021, well, a lot of people just don't want to touch it. And there's lots of drama with the CEO, with acquisitions. You know the whole story. There's a deeper dive on this video on the channel as well. There's a couple of them. You can go check that out after this video. So Unity actually went public in September of 2020. So you had this big rush of IPOs 2020, 2021. Now the forward PE ratio in the purple, of course, you didn't have it here until recently, 57.2. And that's certainly not cheap. But look at the price to sales ratio just to give you an idea here. This was like a 57 price to sales ratio at the peak in the end of 2021. Now it's a 7.2. Definitely not dirt cheap. but heading towards profitability with a lot of exciting new tools, especially when you think of AI. And honestly, there's no other company like Unity. So just to be clear, the company is not profitable yet. They're working towards profitability. The Q2 GAAP EPS was actually negative 51 cents, but it beat by 11 cents. Now revenue, $533.48 million. That beat by $16.13 million, and it was up 79.6% year over year. So you got a company that's growing. It's growing towards profitability. It's not a cheap stock, but it's a heck of a lot cheaper than it has been in the past. It has an exciting future. So if you're looking at a 5-year investment, I think there's some areas here. I'm going to show you a chart. I've followed Unity since before the IPO, and we've made some great calls on this stock, especially over the last 15 months or so. So we circled this and said the stock's probably going to come in this area when it was up higher. We said this is a possibility too if it took another leg lower. It didn't do that. It bottomed out. So this bottomed out around $32, $33 a share. Now this has to break $38 on the upside to get to $40 to $43. If it doesn't break that $38 on the downside, you could see 26 to 30. That's my preferred buying area, is really that 26 to 30. I prefer $30 or less dollar cost average. You might not get it, but that is my preference. And I do think it's possible, even at the price it's at now at 37, that it could climb up to $40 to $43. So if this breaks down and reverses and comes back to trend, you know, under $30 a share, that's where I pound the table on this stock if I'm thinking long term. So this next one, I interviewed the CEO on the channel, and if you have not seen it, go watch it after this video. Indy is creating a broadline auto tech powerhouse, and you can see the different acquisitions the company's made. So this is going to be a small cap, and it's going to be a spec stock, but I'm very excited about the future of this company. Revenue of $52.11 million. Now that's up 102.3% year over year. Indy's been crushing it every quarter. They just keep coming coming and crushing it. The market doesn't care. And I think a lot of people that buy this stock don't understand that it is a spec stock. It's going to take time. This is a 5-year story. It's going to be extremely volatile. And of course, with spec stocks, it's a 10x or 0. There's always a chance that you're wrong. So high risk reward. It's exciting because it's a $1.14 billion market cap. So you say, I want a 10x. Well, you only need $10, $11 billion. Of course, I'm not saying that's simple and just it's going to happen automatically or anything. But my point is it's much simpler to go from a $1 billion market cap to a $10 billion market cap versus a $3 trillion market cap to a $30 trillion market cap. Now, the 52-week range, it did get down to $5.66. The high, $11.12. This does have 12% short interest, so keep that in mind. Price to sales ratio, 6.85. And the company is working towards profitability. It shows here on Fidelity, PE next year's estimate, 38.7. I love this comment right here. I rewatched a video from 18 months ago when the CEO of Indy was on YouTube on the channel Fired Up Wealth. He stated profitability would be achieved at the end of 2023. Last night, the recent earnings call, it was maintained that would still be the case. So working towards to improving those profitability numbers, we're looking at price to sales here, 5.771. Not dirt cheap, but not crazy expensive. And it's the least expensive it's ever been since it's gone public via SPAC. So you can see this is up here at like 40 when it first opened. And of course, at the peak in November of 2021, it was that same level, around 40 price to sales. So down here is the lowest level we've really seen, getting closer to 5-6 price to sales. Again, never buy off analyst price targets. I just think it's interesting to look at. The low, $12. That's a 73% increase from $6.91 where it's at now. The high, $17. That's a 146% return. So the lowest price target is $12 and the highest is $17. Now keep in mind that's only from 6 analysts, but all 6 are buy ratings. In current quarter earnings per share, -4 cents, getting really close to profitability. It's going to report again on November 9th. So I just did a YouTube video a couple videos ago. Indy was on there, best 3 stocks to buy. Indy was the third one. Few people made fun of it. I said, in the $6 range, I think it's a pound the table buy for long-term investors. Again, it's spec. You have to manage spec. You're not just putting your whole portfolio on this. You're going to put a small, 1% of your portfolio tops in something like Indy, in my opinion. I said that it could always go back into the 5s, but I'm saying pound the table spec buy in the 6s. This is this last YouTube video. And that was before it got into the 6s and it got down into the 6s. It's in the 6s right now. So it looks like it's trying to bottom here. It looks like it bounced off about $6.20. And it just closed recently here at $6.91. I think it'll still continue to have some volatility. Don't be surprised if it goes back to under $6.50. Don't be surprised if it goes in the 5s. If you're buying this stock, I think it's a 5-year hold as a spec stock. I think it's like a 10x or 0 type play. But I have a lot of conviction. This is my highest concentration for any spec stock that I have in my portfolio. So we started with a dividend stock. We're going to end with a dividend stock. Tractor Supply Company. Now this did get down to $181.40 on that 52-week low. 52-week high was $251. It's trading at $220.52 right now. It does pay about a 1.9% dividend, and it's about a $24 billion market cap. Short interest, surprisingly, is 7.59%. Price to sales ratio is a 1.64. PEG ratio 2.85. PE for this year's estimate, 21.4. Next year estimate, 19.6. Never buy off these analyst price targets, but just to look at this. So the high, 27% increase, the low, 4.8. Just to give you an idea, this isn't going to be a hyper growth stock or anything like that. It's going to be a DGIF stock, pay a nice little dividend, give you a nice little return. Maybe it slightly outperforms the S&P 500. It's really in a portfolio to help give you some diversification. So recently bounced off about $208. I prefer this stock at $210 or less DCA. I think it's possible you could see $205 or even below $200 if the market rolls over. I think in that $185 to $200 range, it's kind of a pound the table if you're holding it for 5 years. Now, of course, if we go into a bear market and all these stocks sell off 30% and you come back and watch this video, you say, well, you said it was a buy at $200 a share. This is just giving us one moment in time based on what we know today. I like this company long term. If I'm trying to buy this stock, I'm looking at $210 or less dollar cost average. I think right now it's possible you get this run up to about $230 a share. For all these stocks, I would buy on weakness, on red days when it gets into those attractive levels. Remember, September is historically a weak month for stocks. So we could be in for a bumpy ride in September. Although when everybody thinks something's going to happen, a lot of times it doesn't happen. We still have lots of macro risks to consider. It's very hard making a video like this saying here's 7 stocks that I think are buys at these levels and lower, because it's so easy to say, well, just wait for the market to sell off. But timing the market, we know, guys, it's a fool's game. It's very hard to do, and you don't have to be perfect to be successful and achieve financial freedom. I hope this video is helpful, guys. If you're new here, make sure you subscribe to the channel. Make sure to click the like button, drop me a comment. Have a great rest of your day. Take care.